Hey, this is Cece with Options AI. We've got a big day of catalysts today. Of course, it's a FOMC rate decision day that comes before the close. And then after the close, we have Meta and Microsoft reporting. It's kicking off the week that is full of earnings and particularly full of mega cap earnings, with Amazon and Apple going tomorrow. Wanted to take a look at the setup in these two stocks and talk about how to use the Options AI platform to get a sense of potential earnings trades or earnings positioning. As always, we're looking at a 1-year chart. Let's zoom in a little bit. Let's look at this expected move, which is about 5.7%. On that 1-year chart and on the 3-month chart, you can see it here too, is the bullish expected move takes you right up to these prior highs. And on the 1-year chart, you can see that pretty close to back on those February highs. So this makes a lot of sense from a technical perspective to the upside, why the options market is pricing just shy of a 6-point expected move, because with the stock right now at 700, this is the prior highs. A stock tends to find sellers to the downside. A little less clear, but you do pick up a little, this level from May, this consolidation right here, it's just above that. So it makes sense in both directions why the expected move is that amount. And if you look back on the most recent earnings, you see the 4% move, a 2% move, a 4% move, and a 5% move. So 6%, almost 6%, it's a little bit more than what we've seen over the last year on Meta earnings moves. Now, obviously, you've got this pretty crazy chart, which a lot of these mega cap names look this way. So let's look at here in the Iron Condor for selling this move, and let's zoom in on the 1-month chart. Of course, we just talked about that break even at 743 on that 3-month chart is pretty much at those highs. You could, maybe take it a little bit wider if you wanted a little bit more room to each side. You're risking about, it's a 2.5 wide, right? The 662, 660, 742, 745 to the upside. Pretty decent risk reward. You could basically be risking 140 to make 110, let's say. So that is the iron. Obviously directionally might depend on if you have a big bias in this stock, or if you already long the stock, protection. You can do that under this bearish button. You could be looking at put spreads, puts, comparing all of that kind of pricing. So let's go ahead and look at Microsoft, which is a very different chart. And as you can see, there's not really much in the way of the past to look at, like how this expected move of 3.6% was arrived at. You can look at the prior earnings again, like we just did, and you've got a nearly 8% move higher, 6% move lower, 6% move lower, and then it barely moved a year ago exactly. And the market is basically pricing not even a 4% move. Now, part of that has to do with the fact that despite this incredible run of, from these April lows and this gap higher and this you can't even find anything on the chart. We're in rarefied air here. This is not a lot of volatility. You look at this day-to-day volatility in this stock, and it looks like something that just basically goes up 1/4 to 0.5% a day and barely has any down days. So therefore, options, they are compressed, even though there's an earnings, and even though that chart has basically been parabolic, and you would tend to think that there could be some volatility, but options are going to have a hard time pricing something like that where it hasn't moved at all. I mean, it's moving higher, but the day-to-day volatility just hasn't been there for months. Therefore, this one, as a trader, I would look at this, and this makes me a little nervous because there isn't really anything historically to hang your hat on here. The only thing that could maybe give you some comfort if you were selling this move is the lack of volatility in the stock, which can carry over. This could very well be loaded with sellers of options as opposed to buyers of options, and that's why that expected move is kind of small. But this is one where I would probably have a hard time selling an Iron Condor, and in fact might be the type of situation if you're long this stock, you could be looking at put spreads to protect. Maybe this is a stock you never want to sell But obviously, this could easily pull back in the more than 4%, even if it isn't on earnings, if the market even took a 5% downturn. So looking at put spreads to keep you in this stock, to protect you, something like that could make sense. The last one to look at is Robinhood reports. This again is a meme adjacent stock. It's obviously caught up in the crypto and the meme stock trading stories recently, and you can tell that from the chart. I mean, look at that. So this is a little bit more similar to Meta in that there's a little bit to go on over the last month. This expected move is just above these prior highs. 8.5% expected move. Maybe that's something that you could sell. Let's look at what the pricing on that iron condor is. Pretty good risk reward, which allows you, if you wanted to, you can go in here, edit the strikes. You could make this a little bit wider, and you could see now you're risking 65 to potentially make 35, but you've got all this extra room where your break evens are essentially 95 and 117 in either direction. That's a possibility there. Most of the time, these stocks are going to stay within that expected move. When they, particularly this earnings season, we've seen a lot of cases where the stocks that have disappointed these lofty expectations, they've gotten hit pretty hard, and then we've seen short squeezes to the upside. So you want to define risk. This is not something, especially a stock like Robinhood, this is not something you do want to be selling naked calls or a strangle or even cash secured puts into an earnings because of that risk of an 8% expected move becoming a 15% move in this stock.